Hello investors! Welcome to the channel where I talk about investing for the long term through investing in companies that pay a dividend. This is known as dividend growth investing. My name is Michael, and today we're going to start off with looking at how the market ended for the week and look at stock futures. Just looking at a quick look at the major indices for the week. For the S&P 500, it is up 3.17%. For the NASDAQ index, it is up 4.04%. And lastly, for the Dow Jones index, it is up 3.00%. Finally, a good week where the market overall went up in value. That's really good to see if anyone bought in when prices were falling, and now the overall value of his or her investment is up. So now, let's take a look at the major good news that caused the stock market to shift upward this week. So this is the main reason why the stock market has gone up for this week. This week, China has affirmed phase 1 of the US-China deal. After more than 2 years of escalating national threats, tariffs, and trade wars, the United States and China are finally moving forward with the new trade deal between the two countries. The first part of the new trade deal between the United States and China is known as phase 1. Phase 1 is a potentially larger trade agreement between the two countries. A few weeks ago, the two largest economies of the world announced a partial truce which will produce great benefits for both the United States and China. Under the new deal, China has agreed to purchase at least $200 billion worth of product within the agricultural, energy, manufacturing, and financial service sectors of the U.S. economy for the next 2 years. In addition, China promises to protect U.S. companies' intellectual property. They promise to stop forcing U.S. companies to transfer technology for accessing the Chinese market, and they promise to lift financial service barriers to stop currency manipulation. However, this agreement does not go far enough, as it does not address the Chinese government's massive subsidies to support domestic industries, hurting global markets with cheap knockoff products and destroying competitiveness. For months, the two countries have imposed tariffs on each other, which resulted in hurting American farmers and the Chinese economy as a whole. As a result, consumer prices have risen to expensive levels. As part of the new trade agreement, the United States reduced some of the tariffs imposed on Chinese goods, but the majority of the tariffs that are already in place will remain. The tariffs imposed on China and the language of the new trade deal between the two countries will be used to enforce the promise that China made with the US. The Trump administration hopes to use tariffs as a tool to defend workers, manufacturers, innovators, and reduce trade deficits. Ideally, a reduction in trade deficits would mean that more goods and services are produced in the country rather than being outsourced to another country, which can result to more jobs and higher wages. Assuming phase 1 of the new trade agreement between the United States and China followed through very well, there is hope that further negotiations can begin near the end of this month. Now, let's talk about Tesla for a bit. It's interesting to see how the stock has performed in the past couple of days. So, Tesla has this sort of cult persona ranging from its CEO, Elon Musk, to the new products made by the company, like the Cybertruck. Whenever anyone talks about Tesla, it's very split down the middle, meaning that you're either a Tesla supporter or a bull, or a Tesla adversary or a bear. For example, right now, Tesla is considered one of the most shorted stock in the US. Currently, there are a wide range of people who are betting against Tesla and are shorting it to make money. Unfortunately for those people who are bearish on the company, Tesla recently released amazing earnings and the stock price shot up to almost $900 in terms of price. Spiked up here around February 4th, 2020. But then it came back down later at the end of this week to about $750. The stock has gone down mainly because a handful of people have decided to take some profits from the upsurge in price. For full disclosure, I am very long and bullish on Tesla and believe that it can do a lot of great things in the future. The reason for being bullish on Tesla is because in the American market, there aren't a lot of exciting and cool expensive car companies except for maybe Tesla. Tesla, to me, is exciting and cool because the company is investing in electric cars, which can be automated and be sustainable for longer than the gas-guzzling counterparts. Taking a look at here, the main companies I think about when we talk about cars in the United States would be Ford and also General Motors. As we can see here, automobile companies like Ford and General Motors have their stock beaten down because their company isn't innovative, since they still majorly rely on gas-dependent automobiles. For the past year here, last year, Ford had its stock price around $8.33, which has fallen down this year to about $8.11. So not a huge movement of the stock to from start to finish in about a year. If anything, it's been pretty volatile, reaching up to about $10 at maximum and then falling back down to about $8. The same can be said for General Motors stock. It's somewhat volatile because of the nature of the company. The car industry is very cyclical, meaning that it has its high points and its low points throughout the market. And just looking at last year, General Motors started up around $38 and has since then hasn't gone anywhere beyond about $40 to where it is right now, where it's sitting at about $33. Looking at this, these automobile companies in the US, they haven't been very innovative since they still rely on gas-dependent automobiles. And as we know, for the past few weeks, the energy sector pertaining to oil has been hammered down, and therefore automobiles that are gas-reliant also suffer. In addition, the fundamentals behind Ford and General Motors is quite poor at this point, and unless they can change things around, then these car companies will fall out of favor and be replaced with new car companies like Tesla, or they will fall out of favor and be replaced by other services such as Lyft or Uber, which are ride-sharing companies. Now, for the last bit of news, let's take a look at Disney. Recently, Disney has reported its fiscal first quarter 2020 results, and the company has generated about $20.86 billion in revenue and had an earnings per share of $1.53, which has beaten analysts' expectations. As a result, Disney stock continues to climb, and there's only more room to grow. The main exciting news about Disney and why the stock price has gone up so much is their streaming services has just recently launched last quarter, and the success of this side of their business will be crucial to the long-term success of the overall company. From the earnings call, we learned that Disney has over 26.5 million paid subscribers, ranging from mainly North America, Europe, and Australia. In addition, these 26.5 million paid subscribers are averaging about 6 to 7 hours of watch time every week. In addition to the streaming services, Disney has other side business models such as its amusement parks and movie theater releases, which are expected to rise in price in the following year to produce more revenue. Both the amusement park and movie production side of Disney have a lot of untapped potential, which can result in wonderful entertainment for people. With this in mind, I'm excited for Disney and its futures, so as an investor, I will continue to buy more of its stock whenever possible. Now, looking at my portfolio this week and comparing it to the index, for the past week, my portfolio is up 2.08%, causing a gain of about $177. In the past day, my portfolio is down $36. So comparing to last week, I've made almost a full recovery. Looking at this week's results, my portfolio is currently underperforming the market. However, my portfolio is not too far behind, and I'm confident that it will be able to match up and outperform in the following weeks. Looking at my buys and sells for this past week, I invested over $400 into my Roth IRA to buy shares of a couple of companies, and even sold a few because I thought that the profits were just right to take, or there was something fundamentally wrong with the company. Looking at here, on February 3rd, 2020, I bought shares in 11 different companies. I bought shares in 3M, BP, Disney, Genuine Parts and Company, ExxonMobil, VF Corporation, Vermilion Energy, Royal Dutch Shell, Royal Caribbean Cruises, Hands Brands, Shire Energy Partners, and on February 5th, 2020, I bought even more shares after selling a couple of other shares. So on that day, I sold out of Manitech Incorporation and Star Group just because I didn't like how the companies were performing, and fundamentally they were losing a lot of money, and I thought it was a good time to sell. Instead, I bought companies that I do believe in, such as Valero Energy, Procter & Gamble, Hormel Foods, Campbell's, Lancaster Colony, General Mills, Coca-Cola, Cisco Corporation, Colgate, Kellogg's, Brown-Forman, Walmart, Hershey's, Costco, Enbridge, McCormick, Phillips, Pepsi, PBF Logistics, and Kimberly-Clark. I bought shares in those companies because I thought they were all good prices for me to dollar cost average my way into my targeted positions. Furthermore, on a fundamental level, all these companies are pretty solid for the future of their business. All of these companies pay a dividend for holding shares, and ideally, these dividends are set to increase over time. So as long as these companies pay out a dividend that increases over time so that compounding interest can take effect, I will gladly continue to buy shares of that company at a discounted price. In addition, I have also earned a decent amount of dividends from various companies which I can use to reinvest in my portfolio. Over here on the third, I earned 2 cents from ABM, 32 cents from AT&T, 42 cents from Becton Dickinson and Company, 52 cents from CVS, 5 cents from General Mills, 16 cents from Verizon, 31 cents from Star Group, 23 cents from Lowe's, $1.97 from Saratoga, 41 cents from Bank of New York, 7 cents from General Dynamics, 8 cents from MasterCard, and 1 cent from Pintard. These are dividends that I earned as a result of me owning shares of each company. This is money that I did not have to put any effort into besides clicking a few buttons to buy shares. Essentially, I'm earning money while I sleep. This is referred to as passive income, which are derived from enterprises like a rental company or property, which requires little to no effort to maintain and earn. Although these amounts may seem small, every little bit helps and will eventually snowball into something bigger through a compounded effect. Lastly, I want to take a look at the dividend tracker Excel sheet to look at the progress of this portfolio. In the month of January for 2020, this Roth IRA has performed exceptionally well compared to last year. My portfolio was able to generate $18.12 in passive dividend income. This is exceptionally better than when my portfolio started last year, because last year the portfolio didn't generate any income dividends until February of 2019. So as we can see here, the dividends are continuing to grow steadily, and hopefully it will compound into greater and greater effect. This concludes the update portion of my portfolio. Thank you all so much for watching this video until the end. If you like this video, then please give it a thumbs up, as it will help the channel grow immensely. If you have any comments or questions, then please leave them down below in the video, and I'll do my best to personally address it in the comments or answer it in a future video. If you enjoyed this content, then I ask you to please subscribe, as it will help me understand better how to address everybody and grow my channel. I appreciate everyone watching my videos, and I hope to speak with you all again very soon.